In this class we'll deal with performance measurement. Now we're going to separate strategic goals into input and output dimensions. This is a logical thing to do because that's what businesses do. We have inputs into businesses and outputs from business. And of course what the business actually does is process the inputs into the outputs. So it may process raw material into usable output at the end, or it may process data into useful information. It may provide a service if it's a doctor or a solicitor or an accountant or whoever who provides a service. Then the input, and the input is perhaps a legal case that we want to have examined. We go to see a solicitor. The solicitor processes the information, the data from the case, and there's an outcome. So no matter what business we think about, we have inputs and we have outputs, and we have this transformation of inputs into outputs. So really the strategic vision of the business sets a benchmark. It's what the business wants to achieve. And how it's actually doing is then shown up by the performance measurements that we take. So performance measurement looks at particular parts of the business and tries to measure the performance of that particular part of the business. And then weaknesses can be identified. Certain parts of the business are not working effectively, other parts are doing very well, meeting their requirements. So overall, the road to strategic success, to hit the benchmarks that set out in the strategic strategy for the business, these are facilitated through the use of performance measurements. So performance measurements can be conducted right throughout the business in different departments, in different processes, different functions. There's a benchmark for what is good, and anything which falls short of that then may need intervention and investigation. So the processes of the business may be analysed through the use of performance measurement techniques. So when we set strategic goals, it's desirable to separate them out into inputs and output dimensions to see how well the business is doing in the whole process of moving from, if you like, raw inputs, raw materials, raw data into a finished product, and looking at the separate processes within the business, how each one is performing. Now, broad measurement of goal effectiveness. Well, we have an input dimension. Let's deal with that. So, unit cost efficiency. Now, unit costs are very difficult to measure. Management accountants are very good at this. They apportion the overheads, the labour, the machine time, and they're able to get quite good figures on how much an item costs to produce. They may make assumptions about the contribution of the overheads of the premises, of electricity, or of particular workers or whatever, but nonetheless these are useful figures, and they help management in making decisions about the effectiveness of particular processes. So that information is useful. I'd have to say immediately that the cost of collecting and identifying unit costs may not be worth it in small businesses. So management accountants are expensive personnel, and it's only when the business is of a particular size is it worth really doing this. In small businesses, it's left to perhaps the owner or the management to identify performance, and they may identify it by observation, by looking at the process and trying to figure out if it can be done more efficiently and how it's set up and so on. So unit cost efficiency highly desirable figures to have, but maybe more aimed at middle-sized business, middle business, or even large businesses. But small businesses, the management tends to make observations, watch processes, and try to decide if it's efficient or not. But it's important to know how well materials are used. See if there's excessive waste of materials. If it's a manufacturing business, let's say, so raw materials are expensive and they flow in at one end. They come in from the delivery point into the business, perhaps into the stores. If they're then processed, and there's a lot of waste in the process, can that be managed better? Is that a failure of the business? The performance indicators would signal this up, how much of the raw materials can be used and how much of the raw materials is being used. And also, how well is labour used? Labour might find it standing around for a long time waiting. If the production process is badly set up, there may be bottlenecks in some parts of the production system, and in other parts nothing is happening. Bad design, bad management. So how well is labour being used? If labour is being paid for 40 hours or 37 hours a week or whatever it is, are they working for that period, or are they spending long periods waiting for raw materials, waiting for work in progress, waiting for the machines to be fixed? Look at the performance and get a performance measurement of labour to see how well labour is being used. Look at the overheads of the business. There might be a situation where the business does not occupy the whole premises, and a large part of the premises are idle. They're just standing empty. They're not being used for any purpose. Would it be better to downsize, move to a smaller premises which are more economic to run, easier to heat and to maintain, better lighting, and doesn't have that wastage, a lot of wastage in the area. So how well are overheads being used? Not just perhaps the premises, but perhaps certain machinery which are bought in which are not being used efficiently. And there's idle capacity. There's idle capacity in terms of the overheads. Maybe it would be better to outsource that particular work than buy an expensive machine that's only being used a couple of hours a week. Perhaps it would be better to move premises into smaller places if a lot of the premises is not being used. Perhaps the stores are too big. Whatever. So it's important to look critically at the overheads and try to assess the performance of the overheads. Now the output dimension. Well, we have internal results, maintaining and improving quality and lower consumer prices. Well, the internal results is trying to improve quality all the time. That's an ongoing exercise, but at least maintaining it. So looking at how well the business is improving quality, have a performance measure for it, and see if it's able to reduce consumer prices, if it's able to work on costs so it can deliver the product more cheaply in the market. And the external results, well, look at financial returns, look at how well the business is doing overall in terms of profitability of the business, look at the market share of the business, how well it's competing in the marketplace, has it got a competitive advantage, is it developing a competitive advantage, what's its reputation in the marketplace, and so on. And how well does it meet current and future demand? Do customers place orders and have to wait a long time, or are the orders serviced very efficiently and very rapidly so that the customers have a good experience? Now, output measures for each goal. Well, outputs are achievements. These can be categorized into three groups: investment returns, customer satisfaction, and social impacts. So outputs are achievements. That's what the business wants to achieve. It wants to achieve output. So outputs are achievements. And the achievements can be categorized into investment returns, customer satisfaction, and social impacts. Let's have a look at these. Investment returns. Well, what's the percentage return on investment? If the business considers buying a new machine, then what's the return on that machine? Let's say it worked out that the return on the machine was 5%. It estimated the return on the machine is 5%. So now it needs to compare. If it took the money that was going to be invested in the machine and put that money into the bank, what percentage would it get? Well, let's say it got 6% in the bank. So don't invest in the machine. The machine's costing. It's costing money. That's called the opportunity cost. The business must always look at what it could have got from the investment elsewhere. So it's important to look at the return on investment. Look at the return also on the assets employed. Don't just look at the investment for a new machine or a new set of equipment. Look at all of the assets of the business and try to work out the return on the assets. If the return on the assets is very low, perhaps the business really ought to liquidate, sell off the assets and put the money in the bank and do something else. If the return on the assets is high, then it's a good business. It's prospering. Look at the profit margin on sales. Look at the costs of making the products and then how much has been sold for, and look at the difference between the two. If the difference is considerable, it's worth continuing. And all of these should increase by a specific percentage change, and they should be accomplished by a specific date. So looking at the returns on investment, the business should be improving. The returns on the investment should be getting better. The returns on the assets should be getting better. The business is becoming more efficient. And the profit margins should be increasing because costs are falling and the product is good quality. It's highly desirable in the marketplace, so it sells at a good price, good profit margin, and an increasing percentage return on the investment, an increasing percentage return on assets. These are desirable, and these should be set out as targets for the business, and performance measurement should be aiming to achieve, setting up routines to achieve the requirements. So the performance indicators should tell the management what they need to do, where they should intervene in the business in order to achieve these increasing percentage changes. And of course it should be met by a specific date. It's pointless saying that we will improve our performance by 5%. Well, is that over the next 10 years or over the next month? It makes a lot of difference. So it's important to accomplish this by a specific date. Market share. Well, look at the percentage market share relative to the competition. Now that may not be easy to calculate because we'd need to know what the size of the market is, which would have to be estimated. But having estimated it, then the percentage of the market could be calculated. How much of the market is the company supplying? And of course the rest will be supplied by the competitors. So the market share could be calculated or could be estimated. And you should also look at the market share relative to the total market size. Not just the actual market at the moment, but perhaps there is potential in the market for growth. Perhaps the full market is not being tapped. Perhaps companies are only selling to one part of the country. The rest of the country could be tapped as well for sales. So the total market size might be a lot bigger than what is currently supplied. So what's the percentage market share of the total market size? Now these are interesting performance measurements. The market share should be increasing. Well, for a start, if we go back to the financial returns section above, the return on the investment should be increasing, the return on the assets employed should be increasing, the business should be becoming more efficient, so that if it's becoming more efficient, then it's perhaps selling the product at a reduced price. It's able to outcompete its competitors. So its market share should be increasing. Customer satisfaction. Rejection rates in the production process. Now these are an indication of how well the business is satisfying customers. If the customers are not happy with the product, they will return the product. So rejection rates is an indication of customer satisfaction. It's not a very clear indication, because a lot of people may be unhappy about the product and not return it or not reject it. So sales returns and rejection rates, these are two big indicators. The difference between rejection rates is that simply the customers reject the product right at the start. They don't want to know the product. They don't like it right from the start. The sales returns is when they've actually bought it and return it because it didn't satisfy their requirements, their needs. So subsequently they reject it. They return it. So both should decline by a specific amount in a specific time frame. If the business is doing well and performance measurements are taken at one point, if the business is doing well, there should be low sales returns. But there should still be effort put in place to try and reduce it even further. So targets should be set that rejection rates and return rates reduce over time, over a specific measurable time period. Delivery time and in sufficient quantity. Well, both of these are important. The goods are delivered on time, according to customer requirements, and in sufficient quantity. Customers are satisfied with the quantity they can get. So look at back order and delivery statistics and see how well the business is doing. See how many items are produced and see what the share of the market is and what are the likely sales arising out of that percentage share of the market, and compare that to what was delivered to see if there's a shortfall. So these should improve over time. Customer prices. Well, look at the retail price by product. The company may know what it sells the product for, sells the product perhaps to warehouses, and the warehouses then supply to retailers. So there are two more layers of profit taking after the product leaves the business. But ultimately the sales of the business will depend on what the retailers perhaps charge for the product. Now, if the retailers are charging too much, the product will not be bought, and therefore the company will be damaged. And yet the company has nothing to do with it. It's not the company's fault. It's simply the retailers got their pricing wrong. So it's important to look at retail price by product. And the retail price matched to value should decline. So the retail price should be falling. The value should be remaining the same. and that fraction should be declining. The price should be coming down and the value should be remaining the same. So the retail price per value, if you like, per unit value, impossible to measure this, but trying to express it is probably a good way of doing it. Say retail price divided by value. Well, the retail price should be falling, the value remains the same, the value that's in the product, the quality of the product, that should remain the same. Social benefits, well, improve customer satisfaction so that people feel happier and feel better about getting the product. Good consumer feedback, that's important because it means that the customers are so happy with the product they're prepared to give feedback, and they're prepared to perhaps give recommendations to the business which will help the business in refining the product so as to further meet customer requirements. There should be environmental benefits, reduced carbon footprint, trying not to use up too much energy in the production process to show itself as a green producer. It's producing efficiently. So it should reduce pollution, try to stop emissions and clean up the waste before it goes into the environment. So reduce carbon emissions. That's desirable. It's desirable in itself because we don't want to destroy the planet. This is where we live. But also it shows that the company cares, and that helps the reputation of the business. So generally promoting a green agenda is a good idea. It promotes the business, it helps in the marketing effort. But it's also a good thing in itself. So these are areas where performance measurement can help. Performance measurement is trying to measure some activity, the efficiency of some activity against what's expected, or some target that's been set by management. If the management says that 100 should be produced in a day, and when the performance measurement has taken place, 50 has been produced, then management knows that intervention is required. They need to look again at what's happening within that process. Maybe the objective was set too high. Maybe they shouldn't have set 100, they should have set 60. So 50 has actually been produced. Now look at some ways of further increasing it up to the 60 mark. But performance indicators right throughout the business can flag up areas that need intervention by management. But the achievement of all of the performance indicators, if all the performance indicators meet the required targets, then the business itself should be running efficiently. So it's a way of moving from individual processes, individual activities, up to the corporate level, up to the business level, and looking at the efficiency of the business. The efficiency of the business will be good if each of the component parts are running efficiently as well. And that's what performance measurement does. It sees how well they are running and reports back to management its findings, which will trigger investigation, or it may trigger a congratulations to the people who have hit the targets. That's all we're going to deal with in this session, so I'm going to leave it at that and say thank you for watching.